Thank you for joining us. To ensure we have all attendees logged on, we'll just wait one more minute before beginning. Thank you for joining us for BDO's webinar on managing milk price volatility. My name is Brooke Kemsley. I am a chartered accountant with BDO Taranaki, and I will be facilitating this webinar for you today. We would really like to answer your questions, so throughout our discussion, please type your questions into the question box for me to ask the panel on your behalf at the end of today's session. If you're watching on your phone, you will likely find a question mark at the bottom of your screen. If you're on a desktop, first select the orange arrow, then head to the question drop-down section to type in your question. I also have on the screen some tips if you encounter any audio problems. I do need to run through a brief disclaimer here. The advice given today is of a general nature, and it should not be taken as financial advice, and comments cannot be quoted in any media. Please contact your professional advisor for specific advice for your circumstance. I would like to now hand over to Steve Waite, Principal of BDO Taranaki, to introduce today's speakers and topic. Welcome, Steve. Just try and turn your camera on there, Steve, sorry.
No problem. Thanks, Brooke, and good afternoon, everyone. We're often reminded that we live in a world of constant change and volatility. Indeed, dairy farming in New Zealand, with its total dependence on climatic conditions and international trade, has historically been more exposed and more aware than most of the impact of volatility on our business. In more recent years, though, we have seen that volatility, at least around milk price, actually settle down a bit. We've had some stability at reasonable levels. Perhaps we became a bit blasé about it. We've always managed to live with it. We always will. Then along came COVID-19 and all bets are off. Thinking back 6 weeks ago, we had one of our major banks forecasting a payout for the 2020-21 season of $6.40, but acknowledging it could equally still be north of $7. Then within a week, Rabobank came out with a forecast of $5.60. So there we go, everyone. Your payout is expected to be somewhere between $5.60, around most farmers' break-even level, and north of $7, in which case it's happy days. Let's get into some investing in some of that infrastructure and technologies that we're going to need to take on those environmental and regulatory challenges. In my lifetime, I can't recall such a wide spread of expectations. That's uncertainty. That's volatility. The following week, Fonterra fixed price milk offering, as you will know, based on a net $6.32 payout, was oversubscribed by nearly 8 times. So we know there is plenty of appetite among our dairy farmers for products to help manage the risk to their business caused by milk price volatility. Today, we at BDO Taranaki welcome the opportunity to talk with you about this topic, what it is that we're trying to achieve in managing our milk price risk. Without getting too heavy, to talk in simple terms about the theoretical framework of what it is and how all that theory fits into your actual business and your unique individual circumstances. And finally, we'll also talk with you about one of the key tools that is now available to you to help manage this risk in your business. Joining us today are Chris Harvey, agribusiness specialist with us here at BDO Taranaki. With his recent years of experience in the banking industry, dealing with agribusinesses from family-owned and managed farms through to corporates, and his strong interest in the governance of those businesses, Chris is uniquely qualified to talk with us about this topic. We are also pleased to welcome Harry Hewitt from Jarden, brokers, financial and investment advisors. Harry is Vice President of Derivatives, the technical term covering the tools we are going to hear about today, and works directly with businesses throughout the dairy industry to help them mitigate milk price risk. Prior to joining Jarden, Harry was Business Development Manager at NZX and led the development of the listed derivatives market. So again, no one is better qualified than Harry to speak to us today about that particular tool. So welcome everybody, and I'll now hand over to Chris.
Thanks, Steve. Hope you can all hear me. Well, thanks for organising today's webinar. Hi everyone, thanks for joining. I hope everyone is adjusting well to life in level 2. I see we have someone registered today from Ireland, so I hope all is well over there. By way of introduction, my name's Chris Harvey. I'm an agribusiness consultant here at BDO Taranaki. I've spent coming up 15 years in and around agribusiness, and the majority of that time actually in rural banking up until a couple of years ago when I joined BDO. In my last role in banking, I worked alongside a number of corporate farming businesses, and during this time I was lucky enough to get some exposure to futures, but also formal risk management policy. And through this, I had my eyes open to the merits of following a plan when it comes to hedging. There's actually a bit of science behind policy making, and all these larger businesses actually look to buy into. They talk about adopting a passive approach to hedging or following a prescribed plan as opposed to an active one. An active approach being the more common approach when you're making one-off calls based on the information available at the time or forming an independent view. What I learned is that you can achieve a similar outcome around price, even if you got it right all the time, but with a whole lot more certainty and a whole lot less stress. I think we can all resonate with the latter approach, whether with interest rates, any other hedging, and then more often than not, when we try to pick peaks or the troughs, we tend to get it wrong. So today's webinar has come about as a result of increased inquiry, really. Following Fonterra's recent fixed milk price offering and the current uncertainty we're facing around COVID, farmers are wanting more certainty around their bottom line. Fonterra's product, whilst relatively straightforward to use, has very limited volume available. As Steve mentioned, this was made very apparent the April offer with Fonterra's farmers getting scaled back to just 13% of what they applied for. I think it'll be interesting this time around to see how that goes. I think the price offer this last week was $5.87 by Fonterra. So in this presentation, Harry and I will give you an overview of milk futures, a more flexible alternative to Fonterra's offering. But first, I wanted to take a look at strategy and the things you might want to consider before going down this path. I think it's important that before you look at hedging, whether your milk price, interest rates, or forward contracting, feed for that matter, that you start with the why and why you need certainty. Milk futures are just another tool available to manage risk, and in my view, they should be lumped in with fixing your interest rates or locking in your feed price. The only difference is milk price has a much greater bearing on your bottom line, and in this sense, should be getting much more attention. So in terms of agenda, I thought I'd start with setting the scene a bit with an overview of milk price over recent years and also the current outlook. The remainder of my presentation will be around developing a strategy and the other things to consider when forming a plan. Harry will then give you an overview of milk futures and the other tools available to achieve certainty around your milk price. I'll then recap and discuss the bank funding requirements and costs around futures that need to be taken into consideration. There'll be some time at the end of the presentation for questions, but as Brooke mentioned, please feel free to post your queries as the presentation progresses. We'll come back to these at the end. So, setting the scene. So, this is and has been our biggest challenge over recent times, volatility. It's very hard to plan one season to the next when there's up to $4 a kilo price fluctuation to contend with. Often we're able to try and adapt mid-season when it's near on impossible to change a system that's already in place. As you can see, whilst the average price has been fairly strong over the last 10 years at $6.25, the range in price received around this has been significant. A low of $3.90 and a high of $8.40. This has again been highlighted recently as a result of COVID-19. The 2021 futures price as of next season was close to $7.30 back in January. It's now sits south of $6. I think another interesting stat is that Fonterra historically, on average, has been $1 to $1.50 a kilo out from their initial forecast and where the price ended up for that season. I think this is why they've reverted to giving a range in recent years. And I also think it highlights that no one really knows where milk commodity prices will be in 6 to 12 months' time. I also wanted to touch on a couple of stats from the New Zealand dairy industry currently. Debt levels are high. I don't think this will come as a surprise to many of you. The average debt here at $27 a kilo suggests most farmers carry close to 50 to 6% debt as a percentage of their total assets. For any commodity business, this is considered high. The banks now wanting their agri books amortising over a 20-year period, this level of debt translates to a total debt servicing cost of $2.14 a kilo, including principal. This is at 5%, so it might be a little less than this given recent rate drops, but still pretty close to that $2 mark. A significant number of farmers carry debt north of 30 at the moment as well, so that would suggest they've got leverage at between 60 and 70% of their total assets. The break even here for most businesses interest only sits between $5.25 and $5.75. Including the now required debt repayments, this is likely to sit closer to $6.50 for most businesses. So I think these previous slides provide some good context as to why developing a hedging strategy to manage your milk price volatility might be a good idea. Significant volatility and relatively high break-even points in most situations. Right now we have a significant amount of uncertainty to contend with, but I think there's also some significant opportunity. Milk prices around $6 and interest rates below 4. Farm profitability should be fairly sound. With the tools we have available, you can get certainty around both of these numbers currently. Factors discussed so far are the broader industry dynamics. Every business is different. For your business, I think a couple of good questions to ask are, what are you trying to achieve and at what price level can you achieve these goals? What does your profitability look like at 5 or 5.50? And how quickly can we adapt our system to avoid a loss if the power drops $1 a kilo overnight? And right now, if you were to make a loss, would the bank stand behind you and provide facilities to fund that loss? For a lot, it ultimately comes down to personal preference and what individually as business owners you can sleep with at night. Wanted to cover a couple of the common reasons people will look to hedge and why they won't look to hedge. Developing a hedging strategy will be less important for some businesses than others. Reducing volatility is a common one. If you approach hedging the same way each season, i.e. a passive approach as opposed to an active approach as mentioned earlier, you should achieve a smoothing outcome. This will take out the extreme highs, but also the extreme lows and buy you time to respond to price changes. This is what the science tells us. Looking back 6 or 7 years ago, when Fonterra was offering guaranteed milk price or GMP, the biggest mistake people made was not sticking to their plan. If you remember back, this is when Fonterra offered $7 a kilo and the price went to $8.40 in the first season. A lot of people got scared off. The next season following, Fonterra offered up $7 again and the price dropped to $4.25. If you implement a hedging policy, there will be times when you get paid less than your neighbour. This should even out. The key is sticking to your policy each season while it's in place. Another main reason is that some businesses have little choice. If you carry less than 30% debt, your business is likely to be able to ride the wave of volatility. The break-even point will be lower, meaning you are less likely to make a loss. If you carry more than 60% debt, your business is likely to have a higher break-even point, meaning you're more likely to make a loss. In the current environment, if you're carrying greater than 60% debt, as posed earlier, will the bank be in a position to fund that loss? I think if the answer is you're not sure or no, then hedging your risk, whether milk, interest rates, or feed costs, becomes more important, at least while you build some robustness into your balance sheet. Overlaying this is personal preference. As mentioned earlier, ultimately it comes down to what you can sleep with at night. Futures, like fixed interest rates, like forward contracting feed, are useful tools for all businesses if they need more certainty for whatever reason. So looking at the planning side of things and what you might like to look at before you hedge, we suggest documenting the why and what you're trying to achieve first. This will ensure you've thought things through. Documenting this thinking will also help if there are multiple stakeholder views to consider. Agreeing and putting a plan in place up front will ensure buy-in and little risk of dispute later down the track. You want to identify the risks that are unique to your business and why it's important to manage them. Are you more exposed to rising interest rates in the north? The more risk you carry, the more important it is to manage it. You also need to understand the tools that are available and exactly how you're going to act or implement your plan. You need to understand the requirements and risks related to these tools. When developing a plan as business owners, you need to agree and document how you're going to act. We suggest you agree a policy that you're going to stick to for a defined period of time. You don't want this to dominate too much of your time as a group. Agree to the plan, implement it. This plan will be unique to your business and designed for your needs. You also need to discuss your plan with your advisors and bank. For milk futures, there are funding requirements that Harry will talk you through shortly. They also want to understand what you're trying to achieve. A documented plan will help with this. Okay, well, now I'll pass you over to Harry to run you through futures and the other different tools available. I'll let Harry provide you with an introduction. Cheers.
Thanks, Chris. And I think I've got control.
Yep, you're good to go.
Cool, so I work for Jarden, which is, as Steve mentioned at the start, an investment advisory and brokerage business in New Zealand. We are the largest broker in the New Zealand stock market. Our name is perhaps not super well known, but it's got quite a cool background to it, being that the name Jarden comes from an All Black who actually founded our company back in the 60s. Ron Jadon. So from what I've been told over the years of meeting a lot of farmers and whatnot around New Zealand, is that he was a great winger and had a fantastic boot about him. So it's quite cool having that progeny in our name. I've been working for Jadon for about 4.5 years, focusing on this milk price futures and options market. And the core part of my role is really about helping build education, understanding about the use of products. So I do spend a lot of time in traveling around New Zealand and meeting with farmers, accountants, bank managers, and consultants and the like, and just talking about the products, how they work, how they can add value to a farming business. Quite often, and we're quite comfortable saying that it's not a product or a tool that's going to suit everybody. So our objective is more about providing information so people can make an informed decision as to whether or not it suits them. So Chris has touched on the whole fact that dairy is a very dynamic and rapidly changing market. We've had we've noticed a number of changes in recent years, including that banking appetite for agricultural lending has sort of reduced a bit, and we've seen a far greater focus on long-term sustainable business models. There's also increased social pressures, including environmental considerations, that's putting further pressure on business planning and costs. So with that, a need to understand things like milk price hedging has become a bit more important as part of a more sustainable business strategy. In terms of the main product, being milk price futures, it is a financial agreement to sell your milk solids at an agreed fixed price. The idea being that instead of having to wait till 3 or 4 months after the season's ended to know what your exact milk price is for that season, you can use a futures contract to fix that upfront, and that brings with it some certainty around how you can budget and plan for that season. So very important to understand that there isn't actually a physical transfer of milk that we are involved in. This is a totally independent product, financial product that sits to the side. So we're not stepping in and disrupting the supply arrangement a farmer has with their processor. The simplified example that I've got on the slide here is a dairy farmer that sells futures contracts at $7 to provide some certainty to their milk price. So the blue column says, well, what if at the end of the season the final milk price is lower? So you've locked in the futures contract at $7. The final farm gate milk price at the end of the season comes out at $6. So $6 is what's going to be reflected in your milk check. However, you're going to have a $1 gain on your financial or futures contract, which essentially tops up your income back to $7. The yellow or gold column says, well, what if the opposite happens? You lock in a futures contract at $7 and the price rises to $8. So you're getting paid $8 for your milk, but you've got a $1 loss on your financial position, on your hedge, and that's going to bring you back to $7. So the idea and the key principle of hedging isn't about winning or losing or trying to beat the market or trying to beat your neighbour, but it's about providing certainty. And so in this example, the farmer knew upfront $7 is what they were going to get for that season ahead, and they were able to make more informed budgeting and investment decisions on that basis. Each contract that we talk about is for 6,000 kilos. So that's the parcel size that we are trading in. So we've got a very wide range of clients that, some might be doing 1 contract or 5 contracts, and some might be doing 100 or 200. The biggest trade we've done was for 443 contracts. So that's what 2.6-ish million solids off the top of my head. One of the key principles, and where it does start to get a bit complex with futures markets, is around the concept of margin. So we've found the easiest way to talk about this is to split the 2 margin components into 2, which I've done on this slide here. So the first is initial margin. So when entering into a futures trade, you're required to deposit cash, and that's held as collateral against your hedge. In some respects, it's like a bond or a good faith bond. We sometimes use the example that it's like renting out a house. You pay a bond, assuming the house is still in good nick at the end of the lease, you get that bond back. Very much the same concept, but applied to the financial market. So that initial margin rate is actually set by the stock exchange. It's not set by us. So the current rate for, if you were to hedge for the 2020-2021 season, is 40 cents a kilo. So at the time of a trade, you'd be required to deposit 40 cents a kilo to cover your obligations of that. The second component is variation margin. And so at the end of each trading day in the futures market, your position is valued or revalued against the end of day market price, and profits or losses are realized by way of receipt or deposit of funds. So it's essentially a daily wash up. And we do have an example to help kind of communicate how that works. So this slide and the next 2 that follow is a working example. And so what we've done is we've built a theoretical farm with 910 cows, forecast milk production of 360,000 kilograms of milk solids, farm working expenses of $4.20, debt servicing of $1.40, and net stock revenue of 50 cents. And then we've got a strategy. So this one is to hedge a third of the forecast milk production to provide some certainty for that business, and I'm using a price of $7. So a third of the forecast milk production is 120,000 kilos, which equates to 20 futures contracts. So we're selling 20 futures contracts at $7. So that's the strategy. This slide talks about at an overall level how the numbers would work out. So if I talk through scenario one, the column of scenario one, it says, what if at the end of the season the final milk price is $4.90? How would the numbers look? So I've got a third of my production hedged at $7. That leaves essentially 2/3 unhedged, which is just going to be paid the market price of $4.90. So that's going to give me an average price across my total production of $5.60. If I deduct my farm working expenses and debt costs and add in net stock revenue, that's going to give me a net profit of 50 cents a kilo, which equates to $180,000. By comparison, had I not hedged and the final price ended at $4.90, then that's going to equate to a net loss for the season of 20 cents or $72,000. If I skip through to say scenario 4, and it says, well, what if at the end of the season the final price is $7? So I've got a third hedged at $7. That leaves 2/3 unhedged, which is also getting $7. Take out the costs and add back in the net stock revenue, that's going to give me a net profit of $1.90 compared to if I hadn't hedged $1.90. And then scenario 5 says, well, what if the final price was $7.70 as an example? So the idea here is to really look at how, and Chris mentioned the term smoothing, how hedging does essentially provide some element of smoothing to your income stream, where it props up when milk prices do finish at a lower position. From a margin perspective, we'd looked at how the trade practically worked. So if the farmer did the trade on a Monday, so hedged 120,000 kilograms of milk solids at $7, they would have been required to make that initial margin deposit up front. So that would have equated to $48,000. So if we move to Tuesday and let's say the market price moved lower to $6.95. So in that instance, there would have been an MTM gain or a mark-to-market gain of 5 cents on your hedge, which would equate to $6,000. So you'd see a $6,000 credit go onto your account. On Wednesday, we've said that we've had a good GDT auction and the market price moves higher, so it goes from $6.95 up to $7.15. So that $6,000 credit would get deducted, and then there'd be a further call for $18,000. On Thursday, the price moves another 5 cents higher to $7.20, so there'd be a mark-to-market loss on the hedge of another 5 cents and a further debit of $6,000. And then on Friday, the price stays unchanged at $7.20. So the idea of this table, one is to show how margin works, but also a real example and not a prettied version where the market's falling and you're seeing substantial gains come in through your hedging account. And that is the reality. So if I look at the season, the 2020-2021 season for hedging, while we have had a number of our customers that have locked in a portion of their production north of $7, and so they have seen large gains on their hedge, that's not always the case. And there were instances where we were doing hedges for people at $6.50 and the market price did rise up to that $7.30 level. So it is a really important concept to get your head around, and it does come with a funding obligation, which Chris, I think, is going to touch on shortly. Before I pass back to Chris, there are other products that we do offer in the form of milk price options. I won't touch on this too much because it is a fairly complex product and topic, but you're more than welcome, anybody's more than welcome to get in touch with me and we can kind of pick up this conversation at a later stage. However, the two main strategies that we do see in the options market, one is called buying put option. And essentially this is just like purchasing income protection insurance, where you are paying an upfront cost to buy a minimum expected floor price for your milk. It's a very simple strategy. There's no margin requirement. All you're really doing is essentially buying insurance. So we've done a number of these where someone's come in and, you know, looking to basically hedge or buy a floor price that equates to, say, their break even. The benefit also is that if the market rises, then they do get the upside of those high prices. The second is a collar. So it's where you are setting a floor and a ceiling price for your milk. And the idea really is that you're defining the level of volatility that you're a business are exposed to a more comfortable band. So we've done, I'm trying to think of a recent example where we did, say, a trade with the floor price of something like $6.20 and a ceiling of $6.75. So granted, this was a few months ago when the market outlook was a fair bit better than it is now. But in that scenario, it gave the farmer comfort that they knew they were going to be getting no less than $6.20 for their milk for that season, however, no more than $6.75. So it gave them a band or a collar that you know, suited them at the time. So if that's, other than a disclaimer, that's all I have for the moment, and I can pass back to Chris.
Thanks, Harry. Hopefully you can all hear me okay. All right, so yeah, a lot to probably absorb there. I think, you know, at the end of the day, this is all about giving you a bit of a high-level understanding about futures and the requirements. But you know, to Harry's point, if you have any questions following today that you want to ask, feel free to reach out to Harry or myself. I guess just want to recap a little bit on the funding requirements around futures. This is really one of the harder concepts to get an understanding of, but once you dig into it, it actually does become more clear. So funding requirements that you need to discuss with your bank in advance. These are made up of two components, initial margin and variation margin. Initial margin or bond, as Harry said, equates to 6 to 7% of the total contract value, or 40 cents a kilo at $6 milk price. This is required up front, but you'll get this back as your contract reaches maturity. Variation margin or daily calls are in addition to this initial margin. You'll have to cash settle your position relative to market daily. You sell at $6, the price lifts to $6.50 the next day, you'll need to meet the 50 cents owed on your contract that day. This creates a bit of a timing difference. Timing difference is in relation to when you have to meet your daily call and when the Fonterra actually pays you for that season's higher milk price. So if the milk price is lifted to $6.50, that means that you should receive $6.50 from Fonterra by year end. The difference is that the futures market will move in advance of this. The market could lift well in advance of Fonterra actually delivering the cash into your account at season end. This is where you require funding to cover the timing difference. As Harry mentioned, this can go both ways. If the market drops, you actually receive cash in advance. So when you look at funding and what you might need to talk to your bank about, we suggest you look to establish a separate milk futures bank account. This will ensure all futures transactions are kept separate to your main farming activity. We suggest you look to put in place up to $1 a kilo initially. This will cover 40 cents for your initial margin or your bond and provide 60 cents of headroom for any market positions, market movements. If the market was to move significantly overnight, you may require more than this. But remember, you'll receive this from Fonterra at year end, so this position should right itself by season close. As mentioned earlier, the bank will want to see and understand your plan. And generally, they see risk management as a positive, but every business is different and additional facilities may not be a given. Banks will also want to see that you've received some independent support through your process. So talking about process, I thought I'd finish with a bit about process and costs. The process has created a bit of a roadblock for a few over recent weeks. Number one, you need to establish a relationship with a broker, the likes of Harry, and set up an account to get into a position to transact. There's documentation to work through, and this will take time. Once the process is complete, you can communicate your plan and ensure your broker understands quantities and at what price you'd like to trade. Yeah, it's a bit of a waiting game. Your broker will have to work on your behalf to achieve a sale. With regards to costs, brokerage is a relatively negligible component. I think 1 cent a kilo in total. The majority of your costs is related to your margin requirements and the cost of capital whilst these amounts are deposited with the NZX to cover your position. So just some rough workings on this. Cost on this slide comes to just over 9 cents a kilo, so compared to Fonterra's at 10 cents. This is considered a worst case scenario as well, but demonstrates broadly what contributes to the overall cost. Put simply, total cost is made up of a broker charge and the opportunity cost or interest cost related to your margin amounts being deposited with the NZX. A couple of other considerations. Cost estimates on the previous slide were based on some fairly broad assumptions. Number one, you'll not be required to deposit the initial upfront margin amount for the whole season. You'll get this back periodically as the contract reaches maturity. Two, as mentioned earlier, the market can move both ways. If the price drops, you'll get variation margin deposited up front. This can actually assist your cash flow earlier in the season and actually reduce the cost of hedging. But three, also wanted to touch on the fact you can go out further than one season. So at the moment, you can contract for the 21-22 season at around $6 as well. If you're going to go out longer and adopt longer dated positions, there'll be additional margin requirements for these. So potentially there's additional funding required from the bank to venture out this far. So that brings us to a close. In terms of how BDO can assist, if you're considering milk futures, we have a fairly good understanding of the product and should be able to assist with getting you in a position to hedge. This is by no means a one-size-fits-all space when it comes to hedging or risk management. The key is testing your thinking with your decision makers and coming up with a plan that works for you and your business. If you want to pursue this further, feel free to get in touch with myself or Harry. Yeah, thanks for listening in. Hopefully you found that useful. I'll now pass you back to Brooke for Q&A. Cheers.
Thank you, Chris and Harry. I would now like to invite all our speakers to please rejoin using their mics and cameras so that we can get into our Q&A session. Just a reminder that to put your question to us, please first select the orange arrow on the top of your screen and then go down to the question section in the panel there. As you leave today's webinar, you will be asked 3 questions to help us bring you more relevant webinars to you in the future, and we would really appreciate your feedback in this, please. Now on to our first question. Okay, Harry, this one's for you. How do you actually do a trade? Oh, we'll just wait and turn your mic on there, Harry. Hang on a minute. There we go. Harry and Steve, can you please unmute yourselves? And Harry, we've still got you on mute. Oh, a bit of technology issues here, sorry. Okay, we might have to go to a question for Steve while we're trying to get this technology sorted. Steve, you've been around the industry for a while now. What are your thoughts on futures, and are they a good tool?
Yeah, I think they are a good tool, and obviously they're going to take quite a while for people to get their heads around. But as with any powerful tool, we need to know what we're trying to achieve with it. And this issue around establishing a policy and sticking to a policy rather than just using it to try and time the market and be smarter than the market, I think is central to a good risk management strategy. And that's how I see them, as a straight risk management tool. So if we compare them to, say, the Fonterra fixed milk contracts, they're a simplified version based on this product that Harry's talked about, and that's great. They are simple, but they are capacity constrained, and we're all in this industry together. When we find it attractive for one of us to be jumping on a fixed price offering, we'll probably find most of our neighbours want to jump on the same thing. So you end up with not achieving what you wanted to achieve in terms of risk management. So from that point of view, the liquidity in the futures is a really powerful tool, and I'd encourage people to get in there and try. As Chris said, the registration is quite cumbersome with AML these days, so you need to be all set up and ready to get into it when you really need to. I think the options market is going to provide a really powerful tool for people as well, but that maybe is a step too far for people right now. Let's get on board with futures and understand those, and then as our understanding matures, then look at those more sophisticated products.
Great, thank you, Steve. And we can go back to Harry now. We've got the mics working. So the question again for you was, how do you actually do a trade? What's the mechanics of it?
So the process of doing a trade is very similar to share trading. What our objective is, or what we're trying to do, is match willing buyers with willing sellers, and that will determine the price ultimately. So it's quite common that some of our customers would call up me and just ask for a feel of what the market's doing on any given day. So if they were to call me this morning and say, like, I'm trying to sell maybe 10 contracts or hedge 60,000 kilos, what's the market at and what's it doing today? And I'd say we've got some buying interest around $6. Then if they were to actually decide to proceed with that and give us an order to sell 10 contracts at $6, they're not going into the market and matching their selling interest with buying interest. So it's very similar to share trading. The one thing that we do ask for is a written instruction ultimately. So while people are more than welcome to call me, we do get them to send through that instruction via an email or something similar, just so we've got a record that we can keep for compliance purposes.
Yeah, absolutely. Thank you. And just following on from that question, as well as you're talking about the sellers and the buyers. So who are the buyers?
Yeah, it's a good question, and one that we get asked a lot. I guess one way to think about it is as a farmer, the risk to your business is that the milk price falls, and that's going to have a negative impact on your profit margins or your business. So a simple way of looking at who might want to be buying contracts is what sort of business would have a risk if the milk price rose, and where that might negatively impact their business. And that could be something like a food manufacturer, a commodity trader, a milk processor. That's sort of how we approach and build out the buyer market. It is a fairly diverse buyer market, and it's growing every year. But generally, it's businesses that are trying to hedge their exposure themselves. So if you're making a pottle of yogurt or you're making cheese, then their focus is very similar to a farmer's, but it's just from the other side, where they're trying to ensure their own profit margins on that cheese or that yogurt. So it's very much a similar conversation that we're having with a lot of these businesses around New Zealand, and even internationally, where you've got a lot of buyers that have this exposure to the milk price, either directly or indirectly.
Great. And staying with you, Harry, also is, can you exit a hedge?
Yeah, so you can, and that's a real benefit of the market compared to say Fonterra's fixed milk price offering. Because the process or the mechanics of executing hedge, just like a trade, and there are willing buyers and willing sellers at any given time. If for whatever reason you wanted to exit your position, then all you're going to do is come back into the market and buy it back. So buy back the contract that you previously sold. We do talk about, sometimes, and this comes to one of Chris's comments. Why might you want to exit a hedge, and understanding that in advance. And so there are some very valid reasons that could be included in your strategy as to why you want to exit a hedge. One really good example is if you had, say, an adverse weather event impact your milk production. So if we looked at, let's say that you had a target of hedging 50% of your milk production for the season ahead, and then there was a drought that meant that your milk production was going to be down 10%. Now your hedge is going to be greater than what your strategy was. So you might look to reduce your hedge exposure to take into consideration the drought. That could be an example of why someone might look to exit a hedge.
Thank you, Harry. Just one more question that we've got come in is probably for you, Steve, is how would these transactions affect my tax?
Yeah, that's a good question, Brooke. So basically, the Inland Revenue Department in March issued a determination G31, and it's looking to simplify the accounting and taxation of these products. It applies to all taxpayers who are not cash basis holders, and there'll be very few farmers who are cash basis people. Unless those people opt into the regime. And the other people it doesn't apply to are those people that prepare their financial statements under international financial reporting standards, and there will be comparatively few of those around the place. So for the vast majority of taxpayers, the determination treats the initial margin as basically a capital transaction that is held until you recover it in due course, and the variation margins result in a profit or loss that is taxable at that time. When a hedge closes, when a contract closes, then there is technically a base price adjustment which works out the movement in that hedge, whether it's been positive or negative, and whether or not there is a final taxable amount or deductible expense at that time. So it can become a little complex when you've got some contracts being closed out partway through maturity, but for the vast majority, the movements in the variation margin account will be taxable or deductible at the same time as the receiving the cash movement, and the margin will be carried through as capital.
Okay, thank you, Steve. Just a couple more questions just coming in now, probably for you, Harry. Would New Zealand farmers ever hedge different legs, e.g. USD, WMP, currency and or basis?
It's a good question. It's quite a complex question, and it does come to the composition of the milk price. So, at a very high level, the milk price is made up of 6 components, I suppose. So, there's whole milk powder, which is about 63% of it, but a skim milk powder, which is roughly 20 to 22, AMF butter and buttermilk powder. Now, there are futures contracts listed on whole milk powder, skim milk powder, AMF, and butter. And then there's obviously the currency conversion as well. So in theory, yes, you would be able to build a model where you could replicate the milk price by using whole milk powder, skim, AMF, and butter futures instead of the milk price. For an average farmer, it's getting very complex. It's capital intensive. So we've done a little bit of it, and it's certainly possible, but it is a very, very complex model that you and concept that you're talking about. So, I mean, yes and no, I suppose is the answer.
Okay, thank you. And we'll stick with you, Harry. What are the risks associated with undertaking futures? And then there's a second question from that is, what is the process to get signed up and how long does it take?
Yes, on risks, I guess our biggest focus isn't actually on the transacting as much as the education, the information, and making sure people are aware, most importantly, about the implications on cash flow through margin. And I think once you've got a sound level of understanding of those concepts, that certainly reduces a lot of the unknowns when you're approaching the market. In terms of other risks, I guess it comes back to strategy and what you're trying to achieve. And I think that's where we do see providing the greatest value to a farming business is where they've got a very clear objective and they're using futures or options contracts to achieve that objective, as opposed to entering the market and just doing it because. So taking a step back and not looking just at futures, but I think the biggest risk, whether it's futures, options, or even Fonterra's fixed milk price, is not having a plan and making a decision to participate based on a feeling at the time or a conversation that a 5-minute, 10-minute conversation that you had the night before. And I think that's where we've had a lot of phone calls in the last couple of months. And it does come back to that, where people wanting to participate in Fonterra's fixed milk price scheme, for example, but weren't really clear as to why they were doing it and didn't have a clear plan and strategy before they actually started. So I think having a plan is really important, and that's really where the conversation should start. And that helps become a lot clearer and reduce a lot of risks. In terms of the second question, the process of getting signed up, 2 parts to it. So in 2018, Jarden bought ANZ share trading platform, and about 2/3 of all Fonterra farmers use that platform to buy and sell their Fonterra shares through farm source trading. So it's a service offered by Jarden now. That has reduced the barriers to getting signed up with us quite materially, because we have the majority of the information, client information already so if you're one of those 2/3. So the process therefore becomes very specific to our product set and can be done relatively quickly on the basis that all the information's up to date. If they're not in that 2/3, then there is a process, a sign-up process that can take time, and it's a very similar process to if you were to go and get set up with a new bank. Probably the biggest challenge that we face is that trust deeds are quite heavily involved and ingrained in the agriculture sector in New Zealand, and trust is classified as high risk under the Anti-Money Laundering Act. So that therefore means that there's a lot more process, I suppose, or a heavier process that we have to go through around understanding who's involved in the trust, where the source of funds come from, and those sorts of things.
Great, thank you, Harry. Chris, a question for you is, how have you found the bank's responsiveness to support clients with futures?
Yeah, in general, pretty good. When futures and the futures markets first got established, so I was actually privy to a bit of internal conversation with the bank I was with around how they would approach this space and how they would look to support businesses to use futures. A lot of that work actually centered around, well, what are we actually supporting here? And what was pretty clear is that they didn't want to be supporting speculation. So getting away from trying to maximise your milk price and try and pick the top of the market to looking at a consistent risk management approach. So I think, yeah, it's pretty simple really around how you fund the futures requirements. I mean, talked about looking to establish $1 a milk solid. That can be funded by all sorts of different products. The simplest one is just another overdraft at an agreed rate. But generally, what I'm seeing that the banks kind of want to understand what you are trying to achieve. So, what is your plan? What are you trying to protect your business from? And what does your policy kind of look like? And it's something that I know BDO has been looking at, particularly how we can support our clients and going through that process. So we've developed a bit of a policy template which has a few key areas that we can quickly go through with our clients and question their thinking and actually come up with a written plan. So we're finding that if you're going to the bank with some good independent advice, a written sort of document with your thinking, it's a very simple, straightforward process. So I think if you think risk management and trying to manage your bottom line, the banks will be completely on board with us in most situations. But there are situations where there isn't security available, and that's the main challenge. So if your limits are starting to exceed the bank's comfort levels, they may not be in a position to provide extra facilities to allow you to use futures, and it's not always the case, but it's something you need to be aware of, that these may not be a given.
Right, thank you, Chris. That brings us to the end of today's webinar. Thank you, Steve, Chris and Harry, for your input today. And they've covered off a lot of detail, and I guess the main takeaway that I've had from their discussion is to start thinking and planning, and it's not a quick process, so it's something to consider and discuss with your advisors. If you have any specific questions that haven't been answered today, please do feel free to contact any of the speakers directly. And thank you all for your time, and I hope you found it useful, and have a good afternoon. Bye now.